Most people who try to invest, like Warren Buffett, they fail. They lose money, they get frustrated, and eventually they just give up. But what if I told you that the reason you struggle isn't your fault? What if the map you were given for Wall Street was, well, missing all the most important roads? What if the real secret wasn't about picking stocks at all? We're about to uncover the first piece of this hidden puzzle.
I want you to picture this. It's 1974. Wall Street is a complete and total bloodbath. The market has been chopped in half. All those famous can't-lose stocks, they call them the Nifty 50. Some of them are down 90%. 90! Panic is absolutely everywhere. All the smart money is running for the doors. But in a quiet little office in Omaha, one guy is doing the exact opposite. He's buying. He's buying everything he can get his hands on. Why? Because he had a map that nobody else could see. And that map starts right here, with his first and, you could argue, his biggest secret. See, it's not really about what stocks he buys, it's about the money he uses to buy them. He found a kind of glitch in the financial system, one that let him build his entire empire using other people's money, basically for free. I mean, just stop and think about that for a second. If you wanted to invest, you'd have to use your own savings, right? Or you take out a loan with these crippling interest rates. So how on earth did Buffett get his hands on a massive, constantly growing pile of cash that cost him literally nothing? In fact, a lot of the time, he actually got paid to hold on to it. Well, the answer has this simple, almost boring name. It's called the float. You see, at its heart, Berkshire Hathaway isn't really an investment firm. It's a massive insurance company in disguise. And this float? It's the hidden jet engine that powers the entire machine. So here's how this money glitch works, and it's so simple, it's brilliant. You pay your car insurance premium today, but you might not have an accident, if you ever do, for years. In that gap, that float in time, your money isn't just sitting in a bank vault. Nope. Buffett takes that huge pool of cash from millions of people just like you, and he invests it for his own profit. And the scale of this it's just mind-boggling. By 2022, this float had grown to over $160 billion. Can you imagine getting a $160 billion loan that has zero interest, and you never really have to pay it back all at once? It is the ultimate financial superpower. So here's the bottom line. For most of us, we're fighting against this current of high-interest debt, credit cards, loans, where every single day costs us money. But for Buffett, with this float, every single day is another day he gets to command this massive army of free capital. He basically rigged the game in his favor before he even placed a single bet. Okay, so he's got this enormous war chest of free money. So what does he do with it? What does he buy? Well, probably not what you'd think. And that brings us to secret number 2, where we find out why a simple business you can actually understand is way, way better than a complex one you can't. Now, you've probably heard Wall Street guys talk about economic moats. They'll point to a famous logo, a big brand, and say, that's a moat. But come on, history is just a graveyard of famous brands that went totally bankrupt. Buffett's definition is much simpler and, frankly, a lot more ruthless. It has nothing to do with how famous a logo is. It has everything to do with pricing power. This right here is the ultimate test. It's the one question that matters. Can a company raise its prices year after year faster than inflation without its customers leaving? If the answer is yes, then you've found a real fortress. But if the answer is no, you're looking at a business that's just one tough competitor away from total disaster. And there's no better example of this than See's Candies. I mean, think about it. The product, a box of chocolates, it never really changes. But the reason people buy it is purely emotional. You're buying it for your mom for Valentine's Day. Nobody wants to look cheap to save a few bucks. That feeling, that emotional leverage, that is the moat. Customers aren't loyal to the sugar. They're addicted to the feeling of certainty it gives them. It's a money machine. All right, let's move on to secret number 3. So you've got the free money. You've found a great company with a real moat. So what's the next move? Well, the answer goes against every single human instinct you have. It's to do absolutely nothing. Buffett loves this analogy from the baseball legend Ted Williams. See, in baseball, if a perfect pitch comes right down the middle and you don't swing, that's a strike. You get penalized. You're forced to act. But investing? It's totally different. You can stand there all day. You can let thousands of pitches, thousands of opportunities go by, and there's no penalty. You just wait and wait until you get that one perfect pitch that you know is a guaranteed home run. So you gotta ask yourself, are you a Rambo or a sniper? The entire financial world is screaming at you 24/7 to be a Rambo. Buy this, sell that, trade constantly, react to everything, pay all those fees. Buffett's method is the sniper. Extreme, almost boring patience, followed by one single, decisive action when the odds are just overwhelmingly in your favor. And remember that float we talked about? It gives him the freedom to wait. There's no pressure. This is probably one of my favorite mental exercises from Buffett. Imagine you got a punch card with only 20 slots on it, and that's all the investments you can make for your entire life. How would that change things? You wouldn't waste a single punch on a hot tip or a wild guess, would you? No way. You'd research obsessively, you'd demand a huge margin of safety. That mindset alone forces a level of discipline that totally changes the game. And that mindset of being super selective leads us right into our fourth secret. And I'm telling you, this one is probably the most controversial because it completely flies in the face of the first rule that everybody teaches you about money. Wow, just let that one sink in for a minute. Buffett is basically saying that spreading your money across hundreds of different stocks is just admitting that you don't really know what you're doing. It pretty much guarantees you'll get an average result, maybe even less after fees. But think about it. If you've done your homework, if you have real deep conviction in an idea, why on earth would you put money in your 20th best idea instead of putting more into your absolute number one best idea? And this says it all, right? Instead of owning a tiny little piece of everything, Buffett bets big. I mean, at one point, nearly half of Berkshire's entire public stock portfolio was in one single company, Apple. Now, that's not being reckless. That's the ultimate expression of conviction. It's putting your eggs in one basket and then watching that basket like a hawk. Okay, now this is a really crucial point where a lot of beginners get tripped up. People confuse risk and volatility, but they are not the same thing. Volatility is just the stock price jumping up and down day to day. It's noise. It's the market having a mood swing. Real risk is the chance of you permanently losing your money, buying a bad business that goes to zero. Buffett is willing to accept the short-term noise to completely avoid the long-term risk.
And this brings us to the final secret. And honestly, this is the most important one of all. Because you can have all the right tools, you can know all the secrets, but if you don't have the right mindset, you are going to lose. This is about building the psychological armor you need and understanding the one true advantage that you have over Warren Buffett himself. So let me ask you, are you playing to an inner scorecard or an outer one? See, an outer scorecard means you need other people to agree with you to feel like you're smart. So when a stock you buy goes down, you feel like an idiot and you panic and sell at the very bottom. But the inner scorecard, that's different. That means you've done the work, you trust your research, and what the crowd is yelling about is completely and totally irrelevant. To develop that inner scorecard, you have to understand this character Buffett invented called Mr. Market. Just think of him as your business partner who is, well, a manic depressive. Some days he's euphoric and giddy, and he offers to buy your shares from you at ridiculously high prices. Then other days, he's panicked and depressed, and he offers to sell you his shares for pennies on the dollar. Your job is simple. Ignore his crazy mood swings and just exploit his offers. He's there to serve you, not to guide you. But what's the one force, the one thing that holds all of these secrets together and makes them work? It's time. Just look at this. It's absolutely staggering. 99% of Warren Buffett's wealth was earned after his 50th birthday. His real secret wasn't some genius-level returns. It was getting pretty good returns that he was able to just let compound, totally uninterrupted for decade after decade. Most people interrupt that process. He just let the snowball keep rolling and getting bigger. So there you have it. The case is closed. The real crime was a distraction. You were taught to watch the flashing lights of the stock market ticker when the real game was being played somewhere else entirely. It was about financial structure, about unbreakable businesses, and more than anything, about temperament and time. You have the real map now. The only question left is, do you have the courage to actually follow it?